Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Last week, the market index Nifty hit an all-time high. It just crossed 19,200 and then fell back while the Sensex crossed 64,700. There is strong bullishness all around, with some suggesting that the indices would continue to head higher and Nifty would possibly cross 20,000. Suitable narratives are always available to support such market forecasts when stocks break out very strongly or even when they break down. This time, experts point to favorable winds for stocks. There are various factors, which of course is available with the benefit of hindsight as a supportive logic. And these are lower inflation, a pause in hike in interest rates across the world, normalization of the global economy, and of course, which grew massively in 2021, but suffered a lot after Russia invaded Ukraine in February 22. Analysts and fund managers, of course, do not depend only on narratives to forecast the market trend, and they depend on something else, and that is called earnings. Now, this earnings is supposed to provide the logical and the intellectual basis for a market forecast. How is that? According to conventional wisdom, earnings drive stock prices. But unfortunately, it's not so simple. Although earnings growth is expected to drive stock prices higher, in reality, stock prices are determined by countless other real-life factors such as economic, social, political, and so on. Earnings growth is only one of the factors, and because that factor is quite measurable, everybody tends to rely a lot on earnings growth. Unfortunately, that reliance is usually misplaced. Anyone with some knowledge of market behavior knows that earnings and prices can diverge quite a bit and for a long time. Earnings can be stagnant while stock prices head higher, and the opposite can also happen, whereas earnings keep growing, but the stock prices do not. Now, even if you know the extent to which the earnings will rise, it won't help you forecast index movement. And yet, analysts and fund managers have been at this for decades together, for a very long time, trying to forecast the movement of index based on a possible earnings growth. On the other hand, if you know that there will not be any significant rise in earnings and do not invest, stock prices can continue to head higher and you will miss out on serious market up move. Do I have any evidence of this? Of course, I have tons of evidence of this. For instance, in December 2022, Nifty was over 18,800 and in the grip of strong bullishness. Earnings per share of Nifty at that time was 832. By March 2023, 3 months later, earnings had risen to 849. There was no problem in corporate earnings, but Nifty was down 2,000 points. If you think this is a short-term issue, 3 months, short-term, right? Consider the 5-year period between January 2015 and January 2020, a phase of great expectations from the Modi government's first term. 5 years, remember. In January 2015, at the height of bullishness, Nifty EPS was 392. And by January 2020, EPS rose a meager 10% to 431. 10% rise in 5 years. How did the Nifty respond to this anemic growth over 5 years? It shot up 39%. Like everything else in the market, there's only a loose correlation between the variable called earnings and the variable called stock prices. There are periods when EPS and Nifty have risen in tandem, but over long periods, and the majority of the periods, the divergence is far more common occurrence. This is because, why does this happen? It happens because the stock prices and therefore the index prices are often changed a lot or pushed around a lot by what is called sentiment. An extreme case of bad sentiment, for instance, was in 2008. Now, let's see what the earnings were at that time. Between January and November 2008, Nifty crashed by almost 50% from 6,239 to 2,672. It is more than 53%, even as Nifty rose from 222 to 228. So markets tend to diverge from earnings growth in both short as well as in the long term. So is that why market experts fall back on economic narrative to support higher or lower prices? But such narratives are even less connected to stock prices. For instance, one very common narrative is, or one common correlation that people talk about is GDP growth. That is actually the centerpiece of the logic why the market should go up. But GDP growth is not strongly correlated to future index prices at all. One of the best examples of this is China. Throughout the period, China recorded scorching GDP growth. Its stock prices or its stock indices did not go up commensurately. At the same time, compare India and the US. India's GDP growth has been very strong, but in dollar-adjusted terms, in the US market has delivered far better numbers to an investor than their investment in India. In fact, granular data underlying India's economic growth does not look good at all. There is, look at, for instance, private consumption. There's a small number of people at the apex, the rich people, they're consuming a lot, and that's driving a lot of things. Whereas there's a slowdown in the sales of mass consumption items, since a vast majority of lower income group have been affected by inflation and poor income growth. India's economic competitiveness has not improved at all for a variety of reasons, which I will not go into this time. I have mentioned many times in the past, which is red tape and inflation and high cost of doing business and huge overheads and energy costs and so on and so forth, all the frictional cost of doing business in India. But the fact is that India's economic competitiveness has not improved at all, which is very obvious if you see the poor merchandise exports growth. A few pockets of manufacturing excellence, Apple making iPhones out of India and exporting, which grab the headlines, do not change the basic picture. India is not competitive on a global scale. Finally, private investment, which drives a lot of downstream activities, has not yet picked up at all. On the positive side, what is driving the economy, what is driving a lot of economic growth is stupendous state-led push, the central government's push into infrastructure building, railways, and defense expenditures. And these will definitely yield a lot of results. A handful of companies that are getting big orders in engineering and construction, and many of the other companies that are supplying humdrum stuff like pipes and wires and pumps and steel tubes and so on to these projects, they are reporting very strong growth, and the stocks will become multi-baggers possibly. But it is hard to say how much of this will benefit the economy as a whole or continue to benefit the economy as a whole. After all, even Larsen Toubro, India's largest construction company, is not growing. It reported only 3% compounded annual growth in profit in the last 3 years, only 4% CAGR in profit in the last 5 years, and only 9% in the last 9 years. India's largest cement company, Ultratech Cement, their profits have actually declined 4% in the last 3 years. Now, given these facts, while headlines about stock indices being at an all-time high may grab attention, it's senseless to predict whether Nifty is headed. That forecast would depend on the narrative of our choice. If you like this, what you've just heard, please do subscribe and share. Thanks for watching.